focuses on the power sector. The government has upped its forecast of power demand by the year 2032 to 384 gigawatts. That's up 5% from a previous forecast. Given that the peak power demand in the current year was or is about 244 gigawatts, the government is expecting demand to rise by a compounded annual growth rate of 6% over the next 8 years. That will mean commensurate increase in transmission and distribution capacities too. The market has already been rewarding power stocks from Power Grid to NTPC to Tata Power to Adani Power, SJVN, GE, TND. Look at the stocks. It's running for you. They have risen between 80 and 800% in the past 1 year. With the government upping its power demand forecast even more, is there more juice left in power stocks? And if yes, which stocks or sectors? Or can the old nightmare of the power sector, Discom overdues, return to run down the fortunes of power stocks? For all these questions, I have with me two experts. I have Nikhil Nigania, the Director Senior Analyst at Bernstein, and Girishkumar Kadam, Senior Vice President and Group Head Corporate Ratings at ICRA. Gentlemen, good morning and thank you very much indeed for your time. Nikhil, first of all, the math is not kind of convincing. This year, the Power Ministry tells us that demand has risen by 12.7%. And they've upped their forecast only at a 6% CAGR for the next 8 years. Will this be inadequate? How do you make sense of this?
Thanks for having me on the show, Lata. So, see, in terms of power demand, structurally for developing countries, the power demand tends to grow at about 1x of the GDP growth rate. That's a long-term forecast that one typically takes, plus minus maybe 0.8x GDP to 1.1x GDP. That is the range it stays in. Near-term variations do happen, largely due to weather patterns. So last year, for example, was very warm, which led to very higher power demand growth rate, especially in select months like August, September, October. But that's not something we can extrapolate to future years. So from a longer-term perspective, the demand growth forecast of 6% CAGR actually looks realistic. We don't see it being beyond that
point.
Unless...
Oh, no, thanks for enlightening on that point, that it has to be 1x GDP, and then it makes sense if it is, between 6 and 7% annual rate. Girish, how does one fill this gap? 140 gigawatts need to be added, and the government, again, I'm going to the Power Ministry's presentation, we have added only about 10 gigawatts this year. Going by this logic, we have to add 14 gigawatts or even more, I think 16 gigawatts every year. Is it inevitable that we have to do thermal? How do you see this this demand being met?
Yeah, thanks, Lata. So, thanks to the the robust energy demand growth that we are witnessing, clearly, we are seeing uptick in the thermal PLF levels. In fact, the government has revived the focus on incremental thermal capacity addition in the near to medium term. In fact, based on our estimates, there is a clear need for incremental thermal capacity addition, over the next, 5 to 6 year period. We see that assuming the energy demand growth remains at least 6% or closer to 7%, there is a clear need of incremental thermal capacity addition of about 30 to 35 gigawatt, which is over and above the under construction thermal capacity which a sector has, which is anywhere between 25 to 27 gigawatt. So certainly, there is a need for incremental thermal capacity addition, and which is why the government has revived the focus. That's number one. Number two, the incremental, power generating capacity addition will continue to be driven by the renewable energy segment. Now, within the renewable energy segment, the solar segment will continue to be the main driver. And in fact, we are expecting the large capacity addition in the renewable energy segment, anywhere close to 23 to 25 gigawatt to start with next year. This year, we are expecting anywhere between 18 to 20 gigawatt of renewable capacity addition. And going forward, the run rate in terms of the renewable energy capacity addition is required to be well above 25 or to the extent of 30 gigawatt every year. In fact, the targets are pretty ambitious, and they require closer to 40 gigawatt of, the renewable energy capacity addition requirement to meet the policy target of 500 gigawatt cumulatively by 2030. So there are two limited points. One is there is a clear need for the incremental thermal capacity addition. On top of that, because of the policy focus and the the kind of tariff competitiveness which renewable sector has already achieved, we are expecting and we would expect a sizable renewable energy capacity addition to happen over the next 5 to 7 years. So with that,
Okay, got that. Girish, I'm trying to pack in more, let me come back to you for more.
That should fill the supply.
Now, Nikhil, what is the, who are the beneficiaries likely to be? Your own list of recommended stocks is only 4 of them: Power Grid, NTPC, Renew Power and Adani Green. And of that, one of them you have as underperformed, Adani Green. So, it clearly this mantle has to be borne by a lot more companies. Which sectors, if you don't want to name names, will be the beneficiaries?
For sure. So if you look at the beneficiaries, we could cut them into 3. One are obviously the utility names like NTPC and Power Grid, which we continue to like. Power Grid we initiated just last week with an outperform rating, which we see as a beneficiary of the transmission capex need. The second bucket of beneficiaries are the equipment suppliers, some of which you were alluding to earlier, especially the transmission equipment suppliers, where it's not just a domestic theme, it's a global theme, where transmission is becoming incrementally critical for addition of the renewable capacity needed. And the third bucket of beneficiaries are the power financing names. Power financing also, the sector had a very bad phase the last decade, but given the quantum of capex needed for both energy transition and also meeting a non-solar hour power demand with thermal capacity addition, etc., the capex need is going to be gigantic. And hence, power financing companies should see stronger loan book growth with lesser risk of NPAs given largely incremental capacity is renewable, where you have power purchase agreements. So these 3 buckets, utilities, equipment supplier, and power financing names are the key beneficiary.
Okay. Let me take power finance. You don't have coverage at the moment. Can I expect that there will be more and more coverage of power finance and power equipment companies, even from Bernstein, because by your own admission, those will be the beneficiaries?
Hard for us to say in terms of coverage, but in terms of thematic, without a doubt, transmission equipment supplies, we think is, they see massive demand come in, both from India and abroad. And same with the case of power financing, they are less covered names. I think they fall between the cracks between power analyst and financial analyst. But yeah.
No, I take your point. I have the financier analyst also with me. So let me ask Girish. Girish, do you see power finance names, PFC and REC, being, faced with a lot greater demand? And more importantly, this Achilles heel of the power finance companies, discom dues, you think that will not come back to bite them? It's just that the cycle is positive now, but who is to say it won't get worse?
So, Lata, would be difficult for me to comment on individual companies, as we do not.
Yes.
But in terms of discom dues, we have already seen the significant correction in discom dues thanks to, the implementation of the late payment surcharge scheme over the last 1 year. So the legacy dues are getting corrected in a timely manner through EMIs, and even the regular payments by the discoms to the GenCos and the other beneficiaries are happening more or less in a timely manner thanks to LPS scheme. The question is to how long it remains sustained going forward. And from that standpoint, what is really required is the fundamental improvement, the fundamental cash flow improvement for the state-owned discoms, because majority of the state-owned discoms, continue to struggle with structural issues in terms of, the inadequate tariffs, higher than approved, AT&C loss levels, higher than approved cost overheads, and also subsidy related gaps. So these are the fundamental issues. So that's where, the reform measures implementation by the state governments and also by the state discoms proactively is required. Yeah.
Okay, but that's not forthcoming to that extent. I take your point that late payment surcharge has created a big difference in the behavior of discoms. But is it big enough, Nikhil? I was just looking at the finances of PFC and REC. PFC's exposure to discoms has gone up from 30% to 34%. So it's just that the discoms appear to have been able to meet the requirements because of not so much RDSS but more late payment surcharge only by taking more loans. It's just that the bomb is now sitting with the financiers. Are you really convinced that this will not come back to bite? And this is a very important question for people who have already invested. Like I told you, the past stocks have gone up by 80 to 800%. So you think this will not come back to bite? Nikhil.
Yeah. So coming on the discom side, so you're right. So in terms of the lenders, especially, a massive exposure is towards the discoms. But on the discom side, I think one thing which is fundamentally different from the last power cycle which we saw is how active a role a central government is playing in this case. So power, while it's a concurrent subject as per the constitution, the central government has been very clear, even in the RDSS scheme, for example. So funds being given to the states are not just in lieu of, to spend, but there's a very clear milestone attached. So only if you meet those milestones of loss reduction, of reducing your gap between cost of supply and revenue realized, will those funds be dispersed. So the central government, I think, has done a brilliant job from that perspective in making the discoms move towards a better balance sheet and even raising tariffs if needed to reduce the gap for that part. So hence, we see it improving only from a discom side. Plus, from a PFC side, it's a government-to-government loan. Yeah.
Okay. No, I'm sorry, I'm being warned that I'm out of time. So very quick questions to you, Nikhil. You've got the PFC part, I mean the power grid part right. You initiated coverage saying the capex will be higher than the consensus forecast, and the government's forecast is adding to your argument. So, I mean, where do you see the best gains coming in? Will it be in a transmission company, or will it be more in equipment companies? And secondly, yesterday we happened to speak to the NTPC gentleman in charge of renewable, and they seem hell-bent on spinning it off and doing an IPO for their renewable piece. You're against it. So comments on both.
Sure. So let me address the second question first, probably. So yeah, so we have been vocal that listing the renewable business separately is not a great idea. We have seen it happen in Europe, where 4 companies listed their renewable business separately, like Iberdrola, etc., where they had to take it back eventually. A key reason for that is also because renewable is super capex intensive, and coal business or the thermal business for NTPC is a cash generating part. So if you separate them out, it's not an ideal situation to be in, where renewable will need all the funds for capex and thermal will be generating all the funds. So it's not something we are very positive on. And to the first question you had, Lata, so who gains more? Is it the utilities or the equipment suppliers? See, our preference, given our coverage of utilities, we continue to like power grid. So from a stock perspective, that's something we are positive on. But equipment, I can't deny. It's a shorter cycle, so they gain faster. So they should see a bit of margin expansion. And
which explains the 800% rise that GET&D has seen. And even I think transformers and distributors has seen a fairly substantial gain. BHL is in the league for other reasons. So yes, equipment guys are up there. In not adequate time at all to do justice to a sector like this. I hope I'll be able to get both of you again for a half-hour show on the power sector. Thank you very much, Nikhil and Girish, for adding to our understanding of power sector and power stocks. That's it on this edition of It's the Economy. After a break, Chartbusters.